Here we're going to be looking at issuing common stock at its par value, and it's going to involve issue costs here. And we have to note here that the par value of the stock has no relationship to its fair value. And for example here, Corporation A issued 60,000 shares of common stock at $8 per share with its par value set at $3 per share, and the issue costs are $20,000. Now, $8 per share is what they're going to receive here, and again $3 per share is the par value. So looking at how we'd record this here. So first for our cash receipts here on these stocks. So we take these 60,000 shares that are issued here times $8 per share. That gives us $480,000 in cash receipts that we receive here. So $480,000 is what we received here. Debit our cash on our balance sheet here for $480,000. Now moving over to our equity account here, looking at our common stock, and this is where we have to break it apart between the par value of the common stock here and the additional paid-in capital for the common stock. So starting with our par value here, that's set at $3 per share here. So you take the 60,000 shares issued times $3 per share. Par value that you're going to record here under your common stock is $180,000. So you would credit or increase your common stock here for $180,000. Now we have to note here this par value is an arbitrary value, and it's fixed per share here, a fixed dollar amount per share here, and we'll look at what this means here later. Okay, so we've got our credit here to our common stock here of $180,000. We would have received cash here of $480,000. So what we need is this additional paid-in capital here, credit balance here of $300,000, and that's simply the excess over the par value. So we had the par value here at $3, and the cost, or what we received here, is $8. So the difference would go to the excess here. So we got a $5 difference here times the 60,000 shares issued. That equals $300,000. So we'd credit our additional paid-in capital here for $300,000. So remember, the additional paid-in capital is just part of the equity here on this common stock, but we have to record our common stock here. The par value amount here, $180,000, plus the credit here to our additional paid-in capital here of $300,000. So that balances with our debit amount here, the cash we received here at $480,000. Okay, but now we have to deal with these issue costs. So let's go and look at what we're talking about with our issue costs here. So our issue costs, those are the direct costs of issuing the stock, and those would be like the underwriting costs, the accounting, legal fees, printing costs, taxes, and so forth. Now, we've really got two ways of reporting these issue costs here. We'll look at option one here. That's as a reduction to the amount paid into our additional paid-in capital, or option two, our additional paid-in capital would not be reduced for those issue costs, but the direct costs, or those issue costs here, would be capitalized. So let's go and look at our different options here. So first, for our first option here, this is where we would reduce our additional paid-in capital, or debit it here by the amount of those issue costs here of $20,000. And that's simply looking at the net amount here, just to understand what our additional paid-in capital here with that option. Option one would be, we had our cash account here of $480,000 received, the par value here of $180,000. So the difference here gives us our additional paid-in capital. $480 less $180,000 gives us additional paid-in capital here of $300,000. But now we have to subtract out our issue costs, or reduce our additional paid-in capital by those issue costs here of $20,000. So our additional paid-in capital, the net amount here, would be $280,000. Now that's what option one here. So we would have debited or reduced our additional paid-in capital here by $20,000, and the credit amount here would go to the cash account here. We would have credited or reduced our cash account here for $20,000. So credit, reduce cash by $20,000, debit, and reduce your additional paid-in capital by $20,000. Now that's option one here, where we reduced our additional paid-in capital directly. Now we have option two that we can look at here. This is the case here. We would have reduced our cash account directly by those the issue costs here, $20,000. So we would have debited our cash account here for $460,000, and then those issue costs here we would have debited, or we would have set them up as a capitalized amount here, an unamortized cost or a capitalized cost on those the stock issue cost. So this is what we'd be amortizing it here. This would be capitalized here, debit here at $20,000. So we had our cash account here at $460,000 plus the debit to our cash here, plus the $20,000 here debited to our unamortized cost for stock issue costs here. Total amount $480,000. That balances with our common stock, our par value $180,000 here, plus credit amount plus the credit here to our additional paid-in capital of $300,000. So in this case, option 2 here, we did not reduce our additional paid-in capital. We just reduced our cash account by the amount of those costs, and then we capitalized the issue cost here on our asset as an asset here on our balance sheet. So we've capitalized it here, and let's just say for the end of the year here, we would have amortized, say, $5,000 worth of those issue costs here. So at the end of the year, we'd credit or reduce our unamortized cost here of $20,000 by $5,000 here. So our credit, reducing our unamortized cost here, then the balance would go to an amortized cost or an expense here on our income statement. So we would debit that here by $5,000 here for an end of the year entry here, an adjusting entry. So that I'm just looking at those issue costs here, $20,000, and I'm straight line method here, amortizing them over 4 years for this example. That's going to be $5,000 per year. Now that's option 2 here. Remember, option 2, we didn't reduce our additional paid-in capital, but we set up the unamortized or the stock issue costs. We capitalized them and then amortized them down here. So at the end of each period here, we would reduce our unamortized cost here as an asset on our balance sheet, and then we'd recognize here an expense by that amortized amount here on our income statement. Okay, so that takes care of looking at this issuing stock at its par value with the issue costs here. But what we want to look at here is a little further this par value, where it is an arbitrary value here, and it has a fixed amount per share here. So let's go look at that here right now. So here we're going to look at the par value of the stock here as a contingent liability here, and how if the contingent liability is affected here with setting this par value of the stock. So let's just say the stock is issued usually at a low par value to avoid a contingent liability here. So this is what we're talking about. If issuing stock below the par value, you record the discount as a debit or reduction to additional paid-in capital. And the original purchaser or the current holder of the shares issued, the shares that were issued below the par would be required to pay the amount of the discount to prevent creditors from sustaining a loss here if the company were to liquidate. So look at our example here, looking at it in these terms here. So Corporation A, again, issues 60,000 shares at $2 per share here with a par value of $3 per share. So they're issuing it here below the par value. You're only going to receive $2 per share here, and the par value is set at $3 per share. So let's look at how we'd record that here. So first, for our cash account, we'd have 60,000 shares. We'd only receive $2 per share here, so that would be equal to $120,000. So we debit or increase our cash account here for $120,000. And then over on our equity account here for our common stock, again, issued here at a $3 par, we record it at the $3 par amount here, and that was simply the 60,000 shares at $3 per share par here. That's $180,000. Now we only received $120,000, and the par value here was worth $180,000. So the difference here goes to additional paid-in capital, and this is what we're talking about here with this contingent liability. So we would have debited that here for $60,000, or reduced our additional paid-in capital for $60,000. Simply, the cash received here is $120,000 is less than the par amount here of $180,000. So the additional paid-in capital becomes a liability here of $60,000. So you can see it right here. Additional paid-in capital, debit amount here, a reduction to additional paid-in capital is $60,000, plus the debit here to our cash of $120,000 balances with the common stock par amount here of $180,000. So what we're talking about is a liability here, and that becomes the purchaser of the stock or the current stockholder would be required to pay that amount here if the company would liquidate. So that's what the contingent liability is here. So when companies are issuing stock here, they want to issue it with a very low par value here. I've got a little higher par value shown in this example, but typically they want to issue it at a very low par value. Let's just say it would be 25, 30, or 40, 50 cents here instead of the $3. So that would eliminate the possibility here of the purchaser of the stock or the current stockholder being required to pay any contingent liabilities here upon if the company gets in trouble here and they have to liquidate. So that's what we're talking about here with contingent liabilities here. So you want, when you're issuing common stock here, you want to look for a low par value here to make sure that these contingent liabilities don't exist here when you're issuing that stock. So then there can be other legal ramification to it, but I'm just showing you what we mean by this contingent liability. Okay, so that takes care of issuing our stock here at a par value with the issue costs and how it would be recorded here and what we're talking about with this contingent liability involved.